Thank you, everyone. Welcome back. I hope you and loved ones are all doing fine as things normalize somewhat in different parts of the country. We are very happy to restart the Faculty Insight series for the summer. We have an exciting program lined up at least till the end of June, if not beyond. And it gives me great pleasure. In fact, I consider it my privilege to be hosting today Professor Aswath Damodaran. I already see messages in the chat box, from your students, Aswath, who have taken your class, applied all your valuation methods for many, many years. I can tell you, everyone who's in the audience today, that when you think of NYU Stern in India, certainly, but also in other parts of the world, for a large number of student body, that means Aswath Damodaran. So we are delighted to have Aswath with us. As you can imagine, the valuation world in some ways is facing several challenges. We are in a fog of uncertainty, as they say. Is it going to be a V-shaped or a W-shaped or a U-shaped recovery? There's, of course, the great uncertainty as to if and when the vaccine will be found and when it can be delivered in a large measure across various economies. What are the implications of all this for valuation methods, valuation of various markets out there? Do the standard techniques still work? Let me hand it over to the sort of guru of valuation himself. Aswath, over to you. Whenever you want, just let me know and we'll start curating questions.
Okay, let me share my screen and we're all ready to go. I'm glad to be here. It's interesting because as a teacher, I have a very selfish interest in every crisis as a learning opportunity. I mean, I've often described valuation as a craft in the sense that you keep working at it. You never quite perfect it. You keep learning. And the key is to keep learning. And I still remember how the 2008 crisis kind of reframed my thinking about valuation. I had to rewrite big chunks of my books after 2008 because I learned things that I did not know going into that crisis. In fact, almost every sea change I've made in the way I think about valuation has come from being in the middle of troubles and saying, how do we deal with this? Or something different, saying, how do we deal with this? So here's what I thought I would do. I mean, we're well into this crisis. I don't know whether we've seen the bottom of it yet, because crisis is a way of kind of lulling us into a sense of complacency and coming back. But we've seen a fair enough amount of this crisis that we can draw some lessons. So I thought what I'd do today is actually draw 5 lessons that I've learned by looking at this crisis. Some of these lessons I already kind of sensed before the crisis, but they've been reinforced. So with no further ado, let me jump into the first of the lessons. Yeah? Whenever there's a crisis, people like to dump on markets. They like to talk about how crazy markets are, how irrational markets are. And especially in February and March, when markets were swinging around on a day-to-day basis, you saw this kind of get grounded. People said markets are crazy, markets are volatile. In fact, quite a few people suggested we shut down markets early in the crisis, saying, hey, until this crisis is over, maybe we shouldn't let markets operate. And as I've sat through this crisis, I have more respect for markets now than I did 3 months ago, and far less respect for experts. In fact, please spare me market strategists. If I had my druthers, I would ban market strategists from TV, from CNBC, from wherever they show up, because, it's just exercises in ignorance and made up stuff. Have markets been volatile? Yes, absolutely. How could they not be? They reflect the uncertainty we all feel. You look out of your window, you're sitting next to a window. Do you know when you're going to go back to work? Do you feel uncertain? What makes you think markets are somehow not going to face that same degree of uncertainty? That said, though, this has been the most orderly crisis I've ever seen. So let me explain what I mean by orderly crisis. The two words don't seem to go together, but it's not chaos. This market has been remarkably discerning about the way it's dealt with stocks. So let me give you some very quick review of where we are. If you look at this crisis, you can break it up, at least so far, into 2 periods. Between February 14th, which was the start of the crisis in Europe and North America, which is when we woke up to the fact that the crisis was not going to stay in Asia. So February 14th was my start date for this crisis through March 20th. It was terrible, right? We had a meltdown. In fact, collectively, global stocks lost almost $30 trillion. Think about that. It's even difficult to say those words, $30 trillion in market cap between February 14th and March 20th. The low point for this market, at least so far, was March 23rd. And then you saw a turnaround. The turnaround has been pretty dramatic. In fact, through May 1st, stocks had recovered about 16 billion out of the 30 billion, 16 trillion out of the 30 trillion we recovered. So the first thing I want to look at is how the markets played out, not just in equities, but in bonds and commodities. So let's start with equity indices. I'll come back and take a deeper look at stocks broken down by region, by sector. But this is just a glimpse of indices in different parts of the world. Since I've been writing a series of updates on my blog, I'm on to blog post 8, and maybe I'll do blog post 9 and close it off this week. I've been looking at these indices. So you can see it's a subsample of indices. I've broken them down by region and across the world through March 20th. So if you see the middle block, 214 through 320, you can see the damage was immense, 25, 30, even 40% down. The Brazil was down 40%. Since March 20th, you can see the recovery kind of kick in between 320 and 51. You can see how much markets have recovered in that period. So we'll come back and look at equities more closely. But as equities have gone into this meltdown phase, you've seen the rest of the markets respond in pretty predictable ways. Early in the crisis, you saw that so-called flight to safety. I'm not even sure what to call it, but essentially the fact that people, when they get scared, go to something that they believe is safe. And for whatever reason, US Treasuries still have that favored place to go to. And you saw that show up almost immediately in Treasury rates. So if you look at the green, that's the February 14th, 2020 numbers for Treasuries of different maturities. And you can see by April 3rd, which was, I think, the absolute low for the Treasury markets, how much rates had shifted. In fact, much of the drop in Treasuries happened in the first week of this crisis. T-bill rates, T-bond rates, all collapsed. So when people say the Fed did it, the Fed's been the one that's pushing the markets up. Hey, the Fed's effect, to the extent the Fed's effect shows up in interest rates, showed up in the first week of the crisis. You can't use it to explain what's happened since March 20, but that's a different story. But you can see the flight to safety kind of drive down Treasury yields. As that happened, though, at least initially, corporate bond spreads widened. The price of risk always goes up during a crisis. Why? Because people are scared. Risk aversion increases. So if you look at the default spreads broken down by ratings class, across every single ratings class, you see default spreads widen. In fact, they almost tripled between February 14th and April 3rd. Again, that period where they widened the most, that's a tripling of the default spread. A triple B rated bond had a default spread of about 1.33% on February 14th. By April 1st or April 3rd, that was up to almost 4%. And across the board, every single rating class, you see a widening of the price of risk in bond markets. I won't get a chance to show it here, but if those of you are familiar with my implied equity risk premiums, I compute using the index every day. I've been computing the implied equity risk premium for US equities, starting on February 14th, every day through today. So February 14th, we started about 4.7%. There was a day, April 23rd, which was March 23rd, which was the absolute low point for the crisis. The equity risk premium for the S&P 500 was 7.75%, 4.7% to 7.75%. And this again is predictable. During crisis, the price of risk in both equity and bond markets surge, and you saw that happen. Now, commodities, I'm not a commodity guy, but I kept track of two commodities through this crisis. One was copper and the other was oil. Why those two? Those two should be sensitive to the global economy. And not surprisingly, as this crisis has kicked in and people expect the global economy to slow, you've seen these commodities reflect that fear. Copper prices were down about 12%, which makes sense, right? If the economy is going to slow down, copper prices come down. But take a look at oil prices. Brent crude is down 53% through May 1st. And West Texas crude was down 62%. And sometime during this crisis, I think it was April 19, You saw one of those things that happened during a crisis and only during a crisis, where you said, really? I never thought that could happen. And that was the price of crude dropping below zero. You're saying, there, I told you markets were crazy. Actually, there's a very good explanation for why prices dropped below zero. The oil producers kept producing oil because it cost too much to shut an oil production facility down. But there was no place to store the oil. West Texas crude reflected the fact that at least in the US, they were running out of storage capacity. So you saw the price drop below zero. But clearly, if you contrast those two commodities, you can see that what's happening with oil goes well beyond a slowing down of the economy. It reflects the Saudi Arabia-Russia fight. Whatever's going on, something else is going on with oil that goes well beyond this crisis. Finally, I tracked two I don't even know what to call them, assets, collectibles, gold and Bitcoin. Why gold? Because gold historically has been where people go when they get scared. It's a crisis asset. Has it played its role? At least marginally. It's up about 7% during this crisis. And if you talk to gold investors, they're very disappointed. They thought it would be up a lot more because this is exactly the type of crisis gold is supposed to be for, right? But at least it's up. You say, why are you pairing Bitcoin with gold? I've been writing about Bitcoin over the last decade, and I'm never quite sure what the sales pitch for Bitcoin is. Early on, the sales pitch was, it's going to be a currency. It's going to be a currency that competes with sovereign currencies. A currency that nobody uses around the world is a terrible currency. Then I was told that it's like gold. It's going to be the currency that people will flee to when they don't trust paper currencies. In fact, I've taken to calling it millennial gold, which is if you're 30 years old and you're scared, you don't want to buy gold. That's what your parents and grandparents did. You buy Bitcoin. Well, if that's the reason you're buying Bitcoin, you've been terribly disappointed. Because during this crisis, Bitcoin has behaved like very risky equity. It's not behaved like a crisis asset. I don't come to bury Bitcoin, but I don't come to praise it either. But so far, at least, Bitcoin is not doing whatever people told me it would do. Finally, for the last 10 weeks, on every Friday at 1 o'clock, because I'm California, by 1 o'clock in California, every market shut down, I go download the market cap data of every publicly traded company in the world. Sounds like a lot of work, but in today's day and age, it takes 15 minutes to download the data. And then over the weekend, I usually slice and dice the data, breaking it down by region, by sector, by PE ratio. So if you read my blogs, I've pretty much broken it down by any category you want. And here's where you're going to see that markets are actually making more sense than many experts are. First, I've broken down by region. And if you look across regions, see this 26 billion, that's through through March 20th. Collectively, global stocks had lost 26 trillion in value. By May 1st, that had dropped to 15 trillion. Still a pretty substantial loss relative to pre-crisis. But you can see the second half of this crisis has caused at least some of that loss to come back. Looking across regions, the worst performing region in the world is Latin America. I mean, one of the I think, unfair aspects of any global crisis is a global crisis can start in a developed market, but emerging markets feel the pain a lot more. And if you look across regions of the world, it's the emerging markets that are still showing the biggest damage relative to the developed markets. Now, if you break it down by sector, here's where you see what I'm talking about when I talk about markets making sense. Now, if you look across sectors, the least damaged sector has been healthcare. That makes sense, right? I mean, healthcare obviously is in the heart of the storm, but it could potentially have the seeds for curing whatever ails us. Healthcare collectively is down only 5% since the crisis started. The next best is consumer staples. Why? Hey, we keep buying toilet paper like it's going out of stock. The worst performing sector is banks. Banks live in reflected glory and reflected pain. So the reflected pain here is if oil companies stop paying their debt, guess who feels the pain? It's banks. The next worst is energy. But you can see big infrastructure sectors have been hurt more than sectors that can scale up quickly, that are less capital intensive. In fact, I've broken, and you can see this, in fact, in the next page, because I've broken the sectors down into industries. I have 100 industries, and the least damaged, the worst damaged industries. The most damaged industries, heavy infrastructure businesses. Capital intensity seems to be the one variable that explains why damage has been greater in some businesses than others. In fact, I don't think it's capital intensity per se that's the problem. It's how people fund capital intensive businesses. For whatever reason, perhaps reflecting history, capital intensive businesses tend to be funded with debt. And debt has been poisonous during this crisis. The least damaged sectors, online, tech, sectors again with very little capital intensity, less debt, seem to be less damaged. Here's the bottom line though. If you look at the damage across the world in terms of which stocks have been hurt and how, this is what I mean about being an orderly crisis. People are not selling everything. They're selling some companies and buying others. In fact, Amazon hit a new high a couple of weeks ago. But many of the tech stocks, the FAN, we like to dump scorn on them, Facebook, Alphabet, Netflix, Google, etc. Amazon. These stocks have held up remarkably well during this crisis. And there's a good reason for it. I think these companies, because they can scale up and down quickly, have in fact not only not been hurt as much, they might be well positioned to benefit from what's coming when the crisis ends. So that's the first thing. As you listen to experts tell you the market is wrong, my reaction is, yeah, listen to the experts. But you know what? After watching what the markets have done for the last 3 months, I have more respect for what markets are telling me than what experts are telling me. Second, every crisis brings people out of the woodwork. People who have their own theories about what's going on. They all have agendas, and they want to use the crisis to advance their agendas. So I'll give you 2 agendas I've seen advance during this crisis, where people have thrown things out, and I think they just make up crap. I listened to them on CNBC and said, really? So one of the things that I've heard that this is just punishment. Punishment for what? For 10 years of overreaching, of buying tech stocks and pushing them up, and momentum stocks and PE stocks. So I've been told that this is long due punishment for overreaching. So that this is in fact what you get because investors have been shallow. They haven't listened to old time value investors like Warren Buffett. The second agenda I've heard is that buybacks are the problem. If companies hadn't bought back stock, they wouldn't be in the kind of trouble they're in. So I said, okay, let's see if those stories hold up when you look at the evidence. One of the nice things about having the data on every publicly traded company is you can confront each story and say, does that story make sense? So I took the first story, but that this is punishment for growth investing, for investing in momentum stocks. If that story is true, then the stocks that should be punished today should be high PE stocks, high momentum stocks. So I broke stocks down based on their trailing PE ratios on February 14th of 2020, at the start of this crisis. Here's what you see. The lowest PE stocks have been hurt more than the highest PE stocks. In fact, to add insult to injury, money-losing companies have actually been hurt less than the lowest PE stocks. In fact, I also looked at dividend yield. The worst stocks to hold during this crisis have been high dividend yield, low PE stocks. This is very perverse. If I followed old-time value investing advice and bought low PE, high dividend yield stocks supposedly that are safe, I'd have actually been punished more than if I'd gone with the crowd and bought those momentum stocks. In fact, I broke stocks down by momentum class by looking at how much they've gone up in the year leading into February 14th, right? So this is again punishment for momentum. High momentum stocks should be punished more than low momentum stocks. The reverse is true. The stocks that are being punished are the stocks that have done the worst in the last year, the last 5 years, the last 10 years. This is adding insult to injury. In fact, I did a session on value versus growth investing because we were told that value investing was going to come back any day. This crisis has made value investors look even worse. I also looked at the question of whether buybacks were causing the problem. Initially, what I did was I broke down in every part of the world companies that bought back stocks versus companies that did not. Since the biggest number of companies that buy back stock are in the US, let's focus on the US. There were 2,473 companies in the US that bought back stock last year and 2,410 that did not. In fact, almost 50-50. At least on the surface, buyback stocks looked like they did slightly worse than companies that did not buy back stock, by about 3%. But then I broke it down by debt ratio. And when you break it down by debt ratio, it's not the buybacks that are the issue. It's those companies that borrowed money to buy back stock. It's debt again that seems to be the real issue that's driving. I track with dividends as well. Again, you look at dividend-paying stocks. Dividend-paying stocks have been hurt more than non-dividend-paying stocks during this crisis. So as you look at stories and people throw these stories out, play some money ball, look at the data, because often they're basing the stories on something that doesn't really show up in the numbers. Let's talk a little bit about smart money and stupid money. You've heard the legend, right? Smart money is hedge funds and some mutual funds. Stupid money is retail investors. Smart money gets into markets before everybody else does, gets out of markets before everybody else does. They find the right stock. They don't panic. But stupid investors panic, they do. You know what? I've never bought into that notion of smart and stupid money. In fact, in 45 years of looking at markets, I've been looking for smart money. I still haven't found it. In fact, let's look at the evidence on active versus passive, because at least in theory, active investors are the ones who claim to be smart money. We know that history, at least for the last 12 years, has not been a pretty one. Active investors collectively have underperformed passive investors. ETFs, index funds, and money has flowed out of active investing into passive investing. This graph is a graph you might have seen before. The green columns are the money flowing into ETFs and index funds. The red columns are the money flowing out of active funds. And during this decade, you know what active investors told me when I talked to hedge fund managers, I talked to mutual fund managers, they said, just wait. You don't know how much you need us until you have a crisis. That's when you're going to see smart money pop up. Hey, we have a chance. We have a crisis. Let's see how smart money is doing. I know this is fairly preliminary because it's only through the end of the first quarter, but remember the bulk of the damage in this crisis was created by March 23rd. So Morningstar reports returns on mutual funds. Now I'll talk a little bit about hedge funds in a moment. Mutual funds broken down by class, right, into large blend, large growth, 9 classes, and collectively across all US mutual funds. I know it's a very rough test. Collectively, mutual funds, in spite of the fact that they hold cash and should start with an advantage in a period like this one, collectively mutual funds made 21.94% over the first quarter of 2020. Index funds made about 20.57%. During this crisis, which is when you told me that I would need you, you as active investors delivered 1.37% less. We talk to hedge fund people, they claim, well, mutual funds are run by stupid people. We're the smart people. And of course, there have been a couple of stories, anecdotal evidence that hedge fund investors have made some money, right? The Bill Ackman story about buying insurance and making a couple of $1 billion. That's nice. But collectively, hedge funds have had just as much trouble as mutual funds during this crisis. So I'm going to suggest a different criteria for classifying money. So smart money and stupid money. My classification is humble money and arrogant money. You're saying, what's the difference? Arrogant money thinks it already has the answers. It's unbending. It thinks it's right and the market is wrong. It doubles down. Humble money admits that it doesn't know most of the stuff that's going to happen, except when it's making mistakes and changes. If I were to invest my money with somebody, I'm looking for signs for humility. So if you have been losing money during this crisis as an active investor, I want you to come on and say, I screwed up. I didn't see this coming. Don't act like you saw this coming, and act like you never got around to fixing your portfolio. That's a lie. So humble versus arrogant money, keep that in mind as you look at active investing. Now, of course, in the midst of every crisis, we're told that the fundamentals no longer matter. And here's what I've learned in 45 years of living and valuing through crises. It's precisely in the midst of a crisis that the fundamentals matter the most. So when you think about investing in crises, you want to think about fundamentals. And let's think about the fundamentals that drive that. Now, this is a picture I drew for the index, for valuing the index pre-crisis. You're saying that's pre-crisis. You're going to see me use the same framework. If I try to value the index, here's how I value it. I take the expected cash flows in the index, and I can either compute these cash flows from scratch or use dividends and buybacks as a proxy, get cash flows into the future. And I discount it back at a required return for investing in stocks, which is composed of a risk-free rate and an equity risk premium. So basically, it's cash flows discounted back at a cost of equity. I get a value for the index. You see, those were the old days. We're in a crisis. So what if you're in a crisis? The fundamentals stay the same. So in the middle of March, at the height of this crisis, where people were tearing their shirts off saying fundamentals don't matter, I said, I'm going to go back to fundamentals. Here's how the crisis is going to play out. It is going to affect earnings in 2020. There's no debate about it. It's going to devastate earnings in 2020. So if I'm going to value the index, I have to be explicit about what the damage will be in 2020, but I also have to be explicit about how much of the damage will be recovered in 2021, 22, 23, 24, 25. You can't just stop at 2020. Second, I have to figure out how much fears about the future will affect cash return, because after all, companies, when they feel happy and secure, return more cash in dividends and buybacks. Maybe this crisis will reduce cash return, especially in buybacks. Clearly, the crisis has already an effect on the risk-free rate. It's decreased. You saw that with the Treasury rates, but it's going to push up the equity risk-free. So if you look at those four boxes with the red letters in them, those are the questions I need to answer to value the index. And I did. This was the valuation I did close to the bottom of the crisis. I think the index was at 2,400, and I did this. So on March 13, 2020, I valued the index, but rather than do point estimate, it's the height of hubris, right? In the middle of the crisis, how the heck do you know exactly how much earnings will drop? I used a Monte Carlo simulation. I've crystal ball, and I use it all the time with my patients. Excuse me. But basically, I built it around my four big unknowns. How much will 2020 earnings drop? How much will they recover by 2025? What the equity risk premium is? And how much cash should be returned. My median value for the index was about 27.51 at that time. I'm working on an update, which I hope to put out in the next week. But my point is, when people freak out and say, there's no way the S&P should be at 2,900 or 3,000, I say, yes, there is a way. In fact, it's well within the realms of possibility. If you think about not just 2020, but what's coming afterwards. So my advice to you is, when people tell you to abandon fundamentals, go back to them, because those fundamentals are what will allow you to get through this crisis with a framework to think about the effects on value. Now let's talk about the last thing, which is valuing individual companies. I know some of you have been in my valuation classes, and I'm a great believer that every valuation has a story behind it. In fact, I've described valuations as bridges between stories and numbers. Because ultimately, if all you have are numbers on an Excel spreadsheet, you don't have a valuation, you have an Excel spreadsheet. And one of my worries with how valuation has evolved over the last 3 or 4 decades is it's become financial modeling. You're an Excel ninja. And increasingly, I think as we build more details into Excel spreadsheets, we've lost sight of the base of valuation. Too much evaluation has become mechanical. We take Excel spreadsheets, we forecast based on base year numbers. If your idea of valuation is an Excel spreadsheet with mechanical forecasting, you're going to be sunk during this crisis. More than ever before, this crisis is going to draw on how well you can tell stories. So I have a 5-step process that I use to convert stories to numbers. And those of you who are interested in a full-fledged session on this, if you've nothing to do, perhaps you have sleep trouble and you want to fall asleep, there's a Google talk that I gave a few years, maybe 4 or 5 years ago, and I have a book on it as well, on converting stories to numbers. It's a 5-step process. First step, when you ask me to value a company, is to tell a story about the company. And that story can change over time. Second step, you've got to stop and make sure the story you've told is possible, plausible, and probable. Third step, you got to convert that story into inputs, revenue growth. And I keep my valuation simple. I've never built valuations with more than 15 line items in them, or more than 4 or 5 drivers of value. So I convert my story into drivers of value. And my drivers of value, very simply, are going to be revenue growth, operating margins, how much you need to reinvest, and how much risk there is in your story. Finally, I connect those inputs into valuation. It looks like an Excel spreadsheet. When you point to a number and say, why is that number what it is? My answer is always going to be with a story. And finally, I make a big deal about keeping what I call the feedback loop open. That's just a fancy way of saying, don't sit with people who think just like you and talk with them. Seek out people who think least like you, who will critique what you do, because that's the way you make your story better. So when I think about value drivers of a company, as I said, revenue growth is your growth part of your story. I can value pretty much any non-financial service company with these levers. Revenue growth, operating margins tells me something about your business model and profitability. Growth and investment efficiency tells me how easily you deliver growth, how much you need to reinvest to deliver the growth. Your risk-adjusted discount rate, of course, reflects both your cost of equity, the rate at which you can raise money from equity investors, which reflects how much risk people see in your company, as well as the price of risk in the equity market, the equity risk premium, and the cost of debt, which again is a function of your default risk and the price of risk in the bond market, which is the default spread. You take your cash flows, you discount them back at the risk-adjusted discount rate, you get a value, right? Take a valuation class, you're done. You shouldn't be. Because a discounted cash flow valuation is a going concern concept. You know what I mean by that, right? The terminal value, that nirvana that bails you out in a DCF. To get there, you got to assume your company keeps going and going and going. And in a crisis, we wake up to a reality that companies don't always make. It's truncation risk. And you cannot build it into a traditional discounted cash flow valuation. I know people try by pushing up the discount rate. A discount rate is a blunt mechanism. It was never designed to capture this kind of risk. So you have to bring in explicitly the risk of failure into this process to complete your valuation. So I'll show you a valuation from my pre-COVID days. I call these the days of innocence. So I valued Tesla earlier this year on a blog. In fact, I created a do-it-yourself valuation of Tesla. If you get a chance, visit my blog, and you can value Tesla yourself. My point here is not so much the value that you see there, $427, but the fact that I'm telling a story about Tesla. In my story, here's what I'm arguing, that growth in the electric car market and Tesla's early mover and brand name advantages will give it a big chunk of that market. That's going to allow its revenues to grow to about $128 billion. Sometimes we forget what growth rates do to our numbers. $128 billion will make Tesla bigger than BMW. And in my story, I'm making bigger than BMW. I'm assuming that it'll have higher margins than any automobile company in history. In fact, I'm giving it auto tech margins. There's a software component to its revenues that push up margins. I assumed over time tax rates would converge to a global tax rate and that they can reinvest much more efficiently than typical automobile companies. After all, Elon Musk figured out how to build cars in tents. Remember that a couple of years ago? And it's standing him in good stead now in this crisis. So I'm telling you a story about Tesla, and that story gave me a value of $427. I have a long history with Tesla. I've been tarred as both a bear and a bull on Tesla, being hopelessly optimistic and hopelessly pessimistic. And my reaction is, hey, you're welcome to whatever story you want in Tesla. This is my story, my valuation, my decision. So this was a pre-crisis valuation. I'm actually working on a post-crisis valuation of Tesla, and I'll talk about it for a moment. But then the crisis hit. In fact, about 4 weeks after I did my Tesla valuation, the crisis hit. And early in the crisis, I actually drew this picture. It's a very colorful picture, if that's the only thing I can say about it, where I tried to trace out what kinds of companies would be most affected by this crisis. First, I argued the more discretionary your product or services, the more you're going to be affected. Why? Because people are not going to buy your products or services. The more people-intensive your business, theme parks, now obviously, are more affected than businesses that are less people intensive. High fixed cost businesses are being devastated by this crisis. Why? Because you shut your factories down, you still have those costs, you got to meet them. And in a related cost, the more you borrow, the more affected you're by the crisis. So fixed cost and net debt load are both measures of leverage, operating and financial leverage. Highly levered companies are being hurt more. And finally, if you're a company with cash burn, which basically means you've got negative cash flows in the near future. Why? Because you're a growing company. It's not because you're a bad company. You're much more exposed than if you're a company which is cash plus. And finally, if you're a company related to any kind of travel, you're more devastated. Yesterday, when I did this session for an Indian group, actually last Friday, and somebody in the audience asked me about Oyo. And I asked why, what do you think about Oyo? And I said, I think first it's a company without a business model in search of investors, and was lucky to find SoftBank. But if you think about using this picture, clearly Oyo is hopelessly overexposed in multiple dimensions. And if I were SoftBank, I'd have written them down while I was writing down WeWork as well, because damage is coming to SoftBank's investments in many of these businesses. So again, when you have a crisis, the dark side beckons. And I like that word dark side because it's actually people tell you can't do valuation in a crisis, can you? And my response is, why not? In fact, it's precisely when people are giving up that I think the payoff to doing valuation is great. So about 5-6 weeks ago, maybe a little longer, I actually built a spreadsheet. I have a valuation spreadsheet, which is kind of a template, which I use to value any company. I built a Corona version. You're saying, what's special about it? I separated 2020 from the rest of town. Why? Because as long as you stay focused in 2020, you're going to be completely lost. So get 2020 out of the way, then ask the question, what will my company look like in the post-crisis economy? That's what drives value. And guess what? Stories have shifted. And one example, so when you think about how to value companies, basically what you have to think about is what will it do to 2020 numbers? And it could be terrible things. What will it do to post-2020 numbers? So basically, the drivers of value I'm focusing on are exactly the same as I was before crisis. The only thing I do is I'm much more pragmatic about separating 2020 from the rest of town. And I'm going to bring in updated failure rates and updated prices for equity risk and default spreads. And guess what? I can still value companies. So I'll close with a couple of valuations and then open up for questions. One is valuation of Zoom. I mean, has this company's story changed? God, has it changed? I mean, going into the crisis, I actually was lucky enough to value Zoom in February 2020. I valued it at about $35, $40 per share. Why? Because the entire online business meeting market then was estimated to be $19 billion. The entire market across the world, $19 billion. Even if you gave Zoom 50% of that market, you couldn't get the value up. What's changed? Well, we're all on online meetings now. And that by itself is not the issue, that 2020 will be a big year. It's that our behavior could be changed by this crisis. Maybe companies will wake up and say, why are we flying people to Tokyo for a meeting when we can do it on a Zoom session? It's my view, and I think a lot of people share this view, that the business online meeting will be expanded significantly by this crisis. How much? None of us knows, but we still have to make our estimates. In fact, this was early on. I think it was towards early March that I valued this. I have to revalue it. I gave Zoom $11.6 billion in revenues by year 10, which is a pretty hefty chunk of whatever that global market's going to be, 30, 35, 40 billion. And I valued about $50. Now, this is a stock that has, true to its name, kind of shot through the air because it's been the company that people pile on. So, oh my God, this company is going to benefit from it. Chegg is another example, a company that provides online homework help. That clearly the crisis has made their story bigger and more lucrative. And that's what I mean about stories changing. There are some companies that are going to come out of this crisis with much bigger, more lucrative stories. And it's not just the Zooms, the Cheggs of the world. You could argue that in the retail space, Amazon is going to be, in fact, if you think about the FANG stocks and you have nightmares about them taking over the world, those nightmares take on resonance now in the post-crisis period, because those companies are going to emerge out of this crisis stronger than they were going in. One final valuation, then I'll end. I valued Boeing, and this was again quite a while ago, towards the end of March. And Boeing's story obviously has been damaged by this crisis. It's been damaged because, not just because it has debt and people worried about it going under, but because its customers are all basket cases. It's customers of the airlines, and you wonder whether they'll make it, whether they'll ever buy aircraft again. So I valued Boeing with a pretty sober story, a story where they have a terrible 2020. I don't think that's avoidable, where their revenues continue to drop. You see, they drop only 10%. Boeing's revenues dropped in 2019 because of the MAX and the problems they had with the MAX. It was expected to bounce back to about $90 billion. So I've actually dropped it to $69 billion, and then I expect it to recover. Why? Well, think about it. Pre-crisis, there were only two big companies from which you could buy aircraft, Airbus and Boeing. Post-crisis, there are going to be only two companies you're going to buy aircraft from, Airbus and Boeing. They're both in serious trouble. Neither is going anywhere, at least for the near term. I did put a 20% chance that Boeing would not make it. The company itself might, but if it needed a bailout so big, a GM-type bailout, the 2009 bailout that my equity gets wiped out, that's failure for me as an equity investor. My value with this story, which is a story of recovery with a chance of failure, was $147. Stock was trading at $128. And as many of you who've taken my valuation classes know, half my portfolio I've been trapped into buying because I do a valuation and somebody says, are you buying? And I have three choices. I can say no, in which case I've told you I don't trust my own numbers. I can say yes and lie. You have no way of checking. And yes and buy. Well, Boeing is part of my portfolio now. Could I regret it? Absolutely. That's going to be true for any investment, no matter how much hard work you do. So as you look at basics, don't abandon them. Don't let what's going to happen in 2020 kind of drive you away from fundamentals. Right? There is no easy process here. You got to confront uncertainty. I said, look uncertainty in the face. It's less scary if you do so and more realistic. And that's basically what I had, everything I planned to say today. So I'm going to stop there and kind of open up to any questions you might have. But thank you for listening.
That's great. Thank you, Aswath, for the terrific rundown on the state of valuation at present and how to take it forward. We have a host of questions. I thought I'll just start off by relating to something you said, which was very fascinating for me. At the central bank in India, when I was there for 2.5 years, I had a very similar experience, which is that a lot of people think that policy making, crises, etc., are very complex situations, and this is when you abandon your frameworks and theory. And my experience was exactly the reverse, that if in that uncertainty, if you didn't use a framework, you had no clue what was going on. You could justify any action with potentially sort of very, very large costs and errors. So I can completely relate to the frameworks being extremely useful, even in the context of valuation. We have a question that's very close to one of the points you just mentioned, Aswath, on the likely success of FANG stocks going forward. It's from our colleague, Professor Vasant Dhar. And he's raised Scott Galloway, our other colleague's hypothesis that the growth in FANGs may come from them entering the education space. What's your take on this?
I think that this has been an interest. I mean, I've been teaching online for 30 years. I know how difficult it is to teach online. And many people who've taught their first online classes have woken up to the fact that online teaching is not just getting in front of a camera with a microphone and just talking. It's actually 3 times more work, in my view, to teach an online class as it is to teach a regular class. So at one level, it's kind of exposed the fact that universities charge a lot of money for, if you're going to university for just the degree and classes, this has kind of shown you that maybe you don't have to do it. But it's also in a strange way brought home to people who go to universities as to why they go to universities in the first place. And I'll give you my personal experience. My son is a junior at Yale, so he came home for his spring break, and of course he hasn't gone back since. And he misses it immensely. He misses it immensely, not because he wants to be in a physical classroom listening to a lecture, but because, I mean, I did this session about 10 years ago for a business school faculty group called The Barbarians Are at the Gate. Basically, I unpackaged what a university, what you get in 4 years of university. There's, of course, the classes, the degree, but there's the networking, the entertainment, the fact that you can send your 19-year-old to a safe space for 4 years, a mostly safe space. And hope. So I said, look, the problem that online education institutions have had is they think a university is all about the courses and the degree. But it's not. But Scott's point that this could start the process of disruption is true. But I don't think that it's going to be as quick and as easy as he makes it out to be in his talks. The way he frames it, I think universities are facing doom overnight. I think in a strange way, this has reinforced universities for the near term if they can act on it, which means that they have to be physically open at some point in time, and they have to work on creating that environment that goes beyond it's what you learn in the classroom, networking, the kinds of things that students are missing today because they're stuck at home with their parents. So, but I do think it's a cautionary note for universities not to take education for granted.
Aswath, let me turn to then one of the themes that was earlier on in your presentation. We have a question from Ignacio Garcia, an MBA student from Eastern at 95. So Ignacio's question is, you said banks, bank stocks, energy stocks, and aviation have been the worst performers. Is it the right time to jump in?
Well, the right time might be behind you. Energy stocks have actually come back pretty strong in the last. I mean, I bought XLE, which is the ETF that of the big oil companies. I think I bought it 4 weeks ago. Pure luck, you know, because and my reasoning was a simple one. There's no way oil prices can stay at $20 a barrel because the only company in the world that can make money at $20 a barrel is Aramco. And Aramco doesn't want to supply enough oil for the rest of the world because they'll run out of oil. So it was almost like it's one of those few gimmies you get in markets where you know the price is going to bounce back, you just don't know when. So if you've been waiting, maybe there's still oomph left in the return, but a lot of it has already happened in the last 3 weeks. Energy stocks now are significantly higher. Last week alone, I think they were up 6.5%.
Yeah,
bank stocks, I don't know, because I think you have to be more discriminating, because if you're a Texas bank with 80% of your loans to shale oil companies, I'd be very wary. So I think with bank stocks, you can't just randomly jump in and buy banks because they're cheap, because you'd have to look at their exposures to see who they've made their loans to.
Thanks, Aswath. Certainly the bounce in the energy stocks coincides with what we are seeing in oil prices as well. I think as I saw today, they were close to $30 or above. There is 2 or 3 related questions, Aswath. One from Chakshu Modak, class of 2017. Another from Albert Hassan. And then a related one from Nacho Di Zandino. The questions are the current valuations somewhat unjustified in the sense of how sharp the recovery has been, given the difficult macroeconomic numbers that we have seen, which in some cases look certainly worse than 2008 crisis. Some people are saying already comparable to 1929. So why are the markets down only 10%? Is there a lot of froth? And is the froth related to the Fed and the other stimulus that's been put in place?
I think there are a lot of interrelated questions there, but I'll take them one at a time. I think first, I think that as long as you make the debate about what will happen in 2020, I think you've lost the central point of the debate. The problem is not, the question is not what will happen in 2020. We know 2020 is going to be disastrous. We could talk about whether earnings are going to be down 30%, 40%, 50%. The real question is, what will the recovery look like? Even whether it's a V or a U, I mean, that's a trading issue. I'm not going to go fight that fight. But what percentage of this drop that we've seen in this crisis is going to be recovered by 2025? Because even if I delay getting that back, if it doesn't happen in 2023, my value doesn't drop dramatically. The real question is how much of what we've lost this year is irretrievable, things that are never coming back. That, I think, is where you got to look at markets. Could the markets be overshooting? Yes. Relative to who? In a sense, I've told people, and I said this at the CFA conference last week, and people didn't like it. I said, don't project onto markets what your feelings are. So if your feeling is you're going to be in a Great Depression, don't sit there beating up the markets. How come you don't agree with me? I've discovered that on macro issues, at least, my feelings are the least of what I should be thinking about when I think about investing. So could markets be overshooting? Absolutely. Could market strategies be undershooting? Yes. Who do I trust more, market strategies or markets? I'll take markets every single time. So it's entirely possible that markets are overshooting, that there will be a correction. And that's why I said this crisis is not quite over. But I think that in a sense, the frame of debate has shifted. It's no longer about survival, which is what it was in the first 2 or 3 weeks. It's about the nature of the recovery, which is a healthier debate to be having. And as I said, we'll find out. I mean, the numbers are going to start coming in, but the macroeconomic numbers are pretty much useless right now because, I mean, unemployment numbers, production numbers are all going to look awful because the entire economy has been shut down. It's the third quarter numbers we're going to start to see the seeds of recovery and how strong it's going to be and how quickly. And maybe then markets will have to readjust. As I said, having watched markets through these 3 months, I have more respect for markets now than I did going into this crisis. And on the Fed, I mean, I know the Fed has become this excuse for the last 12 years for pretty much everything that investors have seen go wrong. I'm sick and tired of blaming the Fed. I mean, the Fed has actually done a really good job during this crisis. In what way? I've always viewed the Fed's power as being the perception that it has power. So as a central bank, I've always believed they need to be careful about preserving that perception. And one of the best moves that came out of the Fed was early on when they said they were going to come in and backstop corporate debt. They actually didn't do much backstopping, but the very fact that they were there allowed Boeing to go out and raise private debt. And that, to me, was the turning point for this crisis. So when people say, what happened in the middle of March? It was the reality that companies were still able to access private debt markets, something that was not true in 2008. That, in a sense, allowed markets to turn their focus on, okay, survival is here. Let's think about what the recovery will look like. So the Fed's played its role pretty well during this crisis. But to those people who think it's Fed-induced up markets, I don't see that in the numbers.
Thank you, Aswath. Let me turn to one of your points, which was that capital-intensive sectors which have used leverage as a form of finance, they seem to have been very, very exposed in the most recent market corrections. The question is from Raghu Kasturi, which is, have you seen any specific levels of debt in terms of debt to capital or debt to EBITDA ratios that have been crucial to know whether the effects are particularly strong in terms of underperformance?
See, the problem is the denominator is a shifting number, right? So if I take debt to EBITDA for Boeing, it looks pretty good actually there, but it's 2019 EBITDA. This is the problem with all ratios right now, is any accounting or operating number you get for a company reflects a different world, right? So if you look at the airlines, that doesn't look bad if you look at 2019 EBITDA. It just looks awful relative to what it's going to be in 2020. So I think it's a continuum. In fact, when I look, I have a table for net debt to EBITDA broken down globally into 10 deciles. It's actually a pretty continuous slide. This isn't some tipping point. With that tipping point, you're in danger. Markets just get more scared about companies that are more indebted than less indebted. So I think that there's one word that comes out of this crisis that I think I will hold on to in both corporate finance and valuation. It is flexibility. I mean, I'm going to reinforce that whenever I teach a corporate finance class now. When I do a capital budgeting project, it's not just the net present value. It's what options you have to expand and shrink and abandon. This crisis has brought home the value of being flexible in having excess debt capacity, flexible in the way you invest, and flexible in dividends. I know people are dumping on buybacks. You know what? Buybacks are a far better way to return cash flexibly than dividends are. The problem with dividends is they're sticky. I mean, I feel sorry for these oil companies and banks that are stuck with dividends that they have to continue to pay. Because if they'd been doing buybacks, they could have just stopped the buybacks. So in a strange way, buybacks might actually become even more popular after this crisis than before. Because it reinforces the fact that if you're stuck with these static policies and the world is shifting around you, you're going to be in big trouble.
Thank you, Aswath. There's a couple of questions related to the real estate sector. One of them is, what impact do you see on real estate in North America? But I think a much more closer question to the theme of the talk is, how does one value companies such as REITs at a time like this, when a lot of commercial real estate is perhaps not being utilized, a large number of physical spaces are actually not generating the rents that we thought they would?
Well, I mean, if it's an income REIT, you're kind of stuck with whatever the income is, because the REITs are required to pay dividends based on their income. So I would expect many of these REITs to be priced down simply because the expected dividends are low. In the US, I think commercial real estate is going to be in more trouble coming out of this crisis than residential real estate, and here's why. I think commercial real estate is very dependent on brick and mortar retail and restaurant doing well. And if your customers are not doing well, you're not going to do well. And I think there's going to be if brick and mortar retail was in trouble going into this crisis, it is in even more trouble coming out of this crisis. So I think that commercial real estate, I'd be much more worried about than residential real estate, because I think commercial real estate is going to take a real hit. Even if you come back and we recover and we're doing well, I don't think commercial real estate is coming back as strongly. So I think real estate, you got to divide it up into residential and commercial. And in Asia, I think all bets are off because you've had period of not just increasing real estate prices, but zooming real estate prices. I think there's going to be a reassessment of whether those prices have run out of control relative to what you can generate as income on those properties. So real estate goes through booms and busts, and it go through an adjustment phase, and it'll survive and come back. But there'll be some pain along the way.
Thank you, Aswath. A related question from our colleague Dick Berner is, when you're doing valuation in normal times, do you factor in these boom and bust cycles in your story? Do you factor in some notion of a crisis or a systemic risk in normal times?
Well, I mean, if you think about traditional valuation with point estimates, the only way you can show risk is in the discount rate, which is one reason I bring in Monte Carlo simulations and I bring in this truncation risk factor. Because I think traditional discounted cash flow valuation misses those. I mean, it's not just that they're big risks, but they're often catastrophic risks. They're discrete risks. We're not very good at dealing with discrete risk in finance. We're very good at dealing with continuous risk. So I've actually argued that we need to incorporate more probabilistic techniques in valuation, whether it's decision trees, whether it's Monte Carlo simulations. So I'm very fond of bringing in statistical tools to help me deal with the kinds of risks that don't easily get captured in a beta or a cost of equity or cost of capital, because those are the risks that can kill me as an investor if I don't incorporate them in my valuation. But I think I've always been a believer in probabilistic techniques. And I think after a crisis like this one, I think we need to bring in that discrete risk into almost every company we value. And the discrete risk is not always a bad risk. It could be an option to expand that comes about because you have a discrete risk. But I think we need to bring in more explicitly those risks.
We have time for one last question, Aswath. There's another 22 that I haven't had a chance to curate very well. So I'm sure the audience is very much looking forward to the slides and the recording of the talk afterwards as well. But the last question is, it seems that value and momentum strategies seem to be failing, and often they seem to be failing because of geopolitical factors of various sorts. Some of them may be triggered by events such as the pandemic, and some of them may be just entirely geopolitical, like the trade war. Do you think this is the end of value and momentum, or there is still some future to these strategies?
I've been a visitor in Omaha every year for the last 12 years, not to the meetings themselves, but to go talk to the portfolio managers. And for 12 years, I keep saying mean things to them, and they keep inviting me back. But I've argued that value and momentum investing, as practiced today, is failing for a simple reason. It's too lazy. I mean, think about typical value investing. What do? You screen for low price earnings or price to book stocks. You might have an additional screen. You pick stocks based on those screens, and you tell me you've done value investing. What sense is that value investing? No wonder ETFs are eating your lunch, because if what you're doing in investing is mechanical, a machine can do it much better than you can. So I think value and momentum investing is failing. It's been failing for a long time, and it's failing. It's got nothing to do with the crisis, because people applying it use these lazy screens and expect to get rewarded for applying those screens. So you really want to do value investing, then you have to start valuing companies. It's amazing how the word value has been discounted in value investing. Stop treating investors as gods. Stop repeating Warren Buffett's words from his last meeting. I mean, the man is 90 years old. He looked 90, he acted 90, he talked like a 90-year-old. Nothing wrong with that. But why do we keep hearing from value investing the same old thing over and over and over again? So I think the problem with value and momentum investing has nothing to do with the crisis. It's got everything to do with being lazy and being expected to be rewarded for being lazy.
I think that's a good way to wake up the investment world, Aswath. Thank you, participants, for all the questions. I'm sorry we can't do justice to now what's another 25 questions in the chat room. But we will be circulating the video of the talk. If we'll discuss with Professor Damodaran whether the slides are available. I believe they're already available for sharing with the participants. Thank you again, Aswath, for a very, very stimulating talk. I think there's just so much to take home. The one point that stuck for me towards the end was that we'll probably be looking a lot at financial flexibility going forward. And as I see the discussion in the management space, they seem to be talking a lot about operational flexibility on supply chains and things like that as well. So resilience of various types, financial, operational, might actually be a big change that might occur in corporate world, and perhaps something that we might see in the valuation models as well.
We might finally be putting the 20th century to rest, which is the great capital-intensive models which built the 20th century. Industrial base might no longer be the models for the future, but I think we'll wait and see on that.
Thank you again, Aswath, and thank you all the participants. We look forward to seeing many of you, hearing from many of you at our next Faculty Insight series. Thank you also to the admin team for making it work seamlessly again after a break. Look forward to the rest of the summer. Thank you.
Thank you.